Imagine a financial collapse so severe, so incredibly fast, that it threatens to take down the entire United States economy. And the government? They have absolutely zero power to stop it. Instead, the survival of the nation's financial system rests entirely in the hands of a single private banker. This is the true story of the Panic of 1907. Welcome back to Growth Horizon, where we break down the biggest financial collapses in history and the hidden forces that shape the modern economy. Understanding the past to see what's coming next. Let's get into it.
What you're seeing here isn't a parade. It's not a protest. It is pure, visceral financial terror. These are massive, panicked crowds swarming outside of trust companies in New York City back in October of 1907. They are desperate to withdraw their life savings before the doors lock forever. When public confidence completely evaporates, this is exactly what it looks like on the ground.
You know, there's that famous quote attributed to Mark Twain: "History may not repeat itself, but it occasionally rhymes." Well, as we unpack the structural failures that put those terrified people out on the streets, you're going to notice some really eerie similarities to our modern market fragilities. Honestly, understanding 1907 is the ultimate cheat code for understanding how financial systems break down today.
Part 1. The fragile boom and system cracks. So the fatal flaw in the banking architecture of the early 1900s was really a tale of two systems. On one side, the U.S. had heavily regulated national banks, but operating right alongside them were these unregulated shadow banks known as trust companies. Now, trusts were originally just meant to manage estates, but they aggressively expanded into general banking. And here's the kicker. Unlike national banks, which had to keep around 25% of their cash in reserve, these trust companies kept just about 5%. That meant they could offer much higher interest rates to depositors and then use that cash to fund highly speculative investments on Wall Street. It looked like an amazing deal when times were good, but it made the entire system incredibly brittle.
Academics actually point to 7 overlapping factors that created a perfect storm for this crash. You had rapid economic growth and wild speculation colliding with agricultural cash flow seasonality and immense global gold outflows. Plus, there were 16,000 disconnected unit banks operating without a central safety net, or a central bank for that matter. Add in those inadequate safety buffers in the unregulated trusts we just talked about, and then throw in a real economic shock, like the massive San Francisco earthquake and fire of 1906 that drained global liquidity, and you get sudden aggressive interest rate spikes. All the dry tinder was in place. It literally just needed a spark.
Which brings us to Part 2, the panic and spread, a localized gamble.
It's wild how a localized gamble can trigger a nationwide collapse in a matter of days. On October 16th, 2 speculators, F. Augustus Hines and Charles W. Morse, tried and completely failed to corner the market on United Copper stock. When their bid collapsed, depositors at banks associated with Hines panicked and started pulling their money out. This contagion quickly spread by association. By October 18th, word got out that Charles Barney, the president of the massive Knickerbocker Trust Company, had financial ties to those very same speculators. The rumor mill just went into absolute overdrive. On October 21st, the National Bank of Commerce announced it would no longer clear checks for the Knickerbocker, and the very next day, Knickerbocker was forced to suspend operations. The dominoes were falling, and they were falling fast.
And you can see the sheer panic in the data. By late October, the daily maximum call loan interest rate, which is basically the cost for banks and brokers to borrow money overnight, skyrocketed to 100%. No, seriously, 100%. This means market liquidity completely froze. Nobody trusted anyone else enough to lend them a dime. The lifeblood of the economy just stopped flowing. Just to put that level of panic into perspective, on the day Knickerbocker suspended business, terrified depositors drained $8 million from the trust in a matter of hours. And remember, we're talking about 1907 money here. With Knickerbocker out of commission, the public just assumed every single trust company was toxic. The panic went entirely viral.
Part 3. The J.P. Morgan Rescue, de facto central bank.
Enter J. Pierpont Morgan, the absolute colossus of American finance. So he's actually attending a church convention down in Virginia when the panic breaks out, but he immediately rushes back to New York. Because there was no Federal Reserve to print money or organize relief, Morgan essentially became the nation's de facto central bank. He locked the city's most powerful financial leaders in his private library, literally turning the key in the door, and flat out refused to let them leave until they agreed to form a rescue syndicate.
Morgan's triage strategy was ruthless, but man was it effective. First, he had a team led by Benjamin Strong audit the failing institutions. Morgan refused to save Knickerbocker. He just let it fail because he couldn't verify it was solvent. But for others, like the Trust Company of America, he acted fast. Second, he set up emergency lending pools, convincing titans like John D. Rockefeller to pony up tens of millions in cash, and even orchestrated a massive gold shipment from the Bank of France. Finally, he utilized local clearinghouses to issue certificates, which was essentially emergency scrip, to completely bypass the cash freeze and allow banks to settle their balances.
But while Morgan is orchestrating all of this behind closed doors, anxious depositors are still standing in these long, tense lines at institutions like the Lincoln Trust Company, just praying their money is safe. It is such a dramatic reminder of how deeply interconnected high finance is with everyday life. And speaking of making connections, if you want more true stories of the crashes that shape the modern economy, hit subscribe to Growth Horizon and turn on notifications right now.
Part 4. Power, Trust, and Fear. The Aftermath.
To prevent the collapse of a major Wall Street brokerage firm called Moore & Schlie, Morgan proposed that his own company, U.S. Steel, absorb a struggling competitor known as TCI, which the brokerage was using as collateral. But to pull this off, he needed the blessing of President Theodore Roosevelt, who, at the time, had been on a massive anti-monopoly crusade. Roosevelt had to make a critical choice. He temporarily suspended his anti-monopoly enforcement to allow the merger to go through. The president impartially prioritized immediate market stability over his own monopoly concerns, demonstrating how a crisis often forces political leaders to abandon their primary agendas.
But that decision had massive political fallout. Sure, the financial community credited Morgan with saving the nation, but the general public? They were absolutely horrified by the sheer power one private citizen wielded. Morgan was actually forced to testify at the Pujo Committee hearings in 1912. The media narrative shifted entirely from relief to fear. The public demanded systemic reforms to dismantle what they called Morgan's money trust, and this ultimately led to the creation of the Federal Reserve in 1913, ensuring that a private citizen would never have to play this role again.
Part 5. Modern Volatility, Echoes of the Past. History is rhyming loud and clear here, folks. Just think about it. In 1907, unregulated trust companies drove the speculative boom. In 2008, it was the modern shadow banking system of investment banks and hedge funds. In 1907, the toxic assets were tied to copper corner schemes. In 2008, it was toxic mortgage-backed securities. And while in 1907, the J.P. Morgan syndicate provided the bailout liquidity, well, in 2008, the Federal Reserve and the government's TARP program stepped in. The mechanisms evolve, for sure, but the boom-to-bust psychology remains absolutely identical.
Part 6. Warning Signs for Today.
First, we have to consider system complexity. Back in 1907, there were 16,000 highly fragmented banks. A century later, leading into 2007, consolidation brought that number down to roughly 7,500. Yet both systems proved incredibly brittle the second overnight lending and liquidity dried up. Today's global trade dependencies mean a shock isn't just national anymore, it is instantly global. Systemic risk doesn't disappear, it just changes shape.
Second, watch out for information asymmetry. That's a fancy way of saying institutions have the real data while the public is left completely in the dark. In 1907, nobody knew which banks were actually healthy, so they just assumed none of them were. When the public lacks facts, rumor and panic will always fill the void, creating a self-reinforcing downward spiral. Transparency is the ultimate shock absorber.
So the next financial crisis, who's going to be the one to fix it? Because in 2008, there wasn't a Morgan. If you want more true stories of the crashes that shaped the modern economy, hit subscribe to Growth Horizon and turn on notifications. Let me know in the comments, which crash should we break down next? Thanks for watching.